This episode is brought to you by Marqeta. Payment programs that scale and customer experiences that inspire. Don't sacrifice one for the other. Choose a payments provider who can deliver on both. Choose Marqeta. Learn more at marqeta.com/FTT. Hello, and welcome back to another edition of Not Fintech Investment Advice, featuring Simon Taylor, author of the great newsletter FinTech Brain Food, one of the minds behind the FinTech NerdCon conference, which I just got back from. It was great to connect with Simon one more time in 2025 to talk about fintech companies that we find interesting. We got into first-party fraud. We got into, of course, lots of agentic AI conversations around mortgage lending, small business lending. We talked about how we can better facilitate the integration of guarantors and government guarantees into small business lending. We talked about the value of learning from innovations in other markets. And then Simon makes a plea at the end of the podcast for more solutions focused on the problem of financial nihilism, which is a topic that I share a great deal of passion with him on. It was a great conversation. As always, Simon is a delight to talk to and to bounce these companies back and forth on. I hope you enjoy this episode, and I hope you've enjoyed a year of Not Fintech Investment Advice. So here is the final episode of 2025 with Simon Taylor. This is FinTech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the FinTech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, he is back from his adventures in Miami, Florida. He still presumably has his passport clutched tightly to his chest. We have Simon Taylor here. Oh my goodness, for people watching, he has his passport literally in front of him. Do you ever let it go now, or do you just hand?
I sleep with it. I cuddle it. It's never getting lost ever again. Contrary to the rumor that was speculating, I did actually want to go to Money 2020, guys. I wanted to be there. I'm just an idiot. But it ended up being really good marketing for FinTech NerdCon. Turns out being an idiot is good marketing, so long may that continue. But yeah,
it's like the cousin to rage bait almost, right? Like it's just a different version of drawing attention, but it worked for you. You made it work.
It did, and I'm super glad that everybody came down to Miami. We've got incredible feedback. Thank you for hosting podcasts there and being there and bringing the FinTech Takes community, but also just everyone that came seemed to really enjoy the vibe and the energy of operators who are allowed to speak fintech and not have to translate it all the time. And I think we do have our little in crowd sometimes, and it's good to try and take the whole industry with us sometimes. Yeah, but sometimes it's really nice to just start talking in jargon and be like, okay, this is just so much more efficient. I can get things done. And that's what makes us nerds, man.
It was fun. Well, I will say compliments on the event. It went very well. The vibe I sort of felt when I was walking around the show was it sort of felt like the best possible version of a startup in event form, right? Where it was it had this kind of raw, very high energy, intense, lots of passionate conversations, but then interspersed with goofiness and silliness, right? I found some time to play Super Smash Bros with a few folks just in between podcasts that I was doing, and just things that I don't know, sometimes events feel a little overproduced or overpolished, maybe is the right way to think about it. And obviously you and Colton and the whole team, Joy, did a great job on the event, but without making it feel overly polished or produced. And that's a hard balance to strike, but I definitely came across in the event. Sounds like that's kind of what you were going for.
Yeah, look, I wanted a place where you could relax and have a conversation. And what I find is when you create this space that people can relax in, they have better conversations. I spoke to one founder who came off stage and said, a top 10 US bank came and said, hey, we'd love you to be in our RFP. And then a giant SaaS company said, hey, we'd love to talk to you. And that, I think, came from the fact that they'd seen him sort of present something playfully and not necessarily present it in the classic demo fashion. And when people get that brief, I don't know, it creates a different level of engagement. And if you look at my career in the past decade, what have I been trying to do? I've been trying to change B2B comms. B2B comms with a human at the front is far more interesting. And that's what you do, Alex, right? Like, people follow Alex and FinTech Takes because of your voice. We know you hate prediction markets because they're really gambling. And we buy into that character. We know you're the weird credit nerd, and we buy into that character. And I think that is much more impactful because people ultimately buy from people.
Yeah, you're articulating my company's sort of core philosophy and guiding principle very, very well. But I think you're exactly right. I mean, the B2B, but sounds like humans. It's amazing how many miles you can get out of that, how you can extract just value out of that very simple concept. I constantly try to remind people when they're doing podcasts or when they're speaking at events or they're writing or whatever, they'll be like, well, what feedback do you have or what advice do you have? I'm like, just make it more like you're talking like a normal human. Like, how would you just talk to someone about, and it's so funny because I think everyone in this industry kind of by default is trained to not talk like a human, to talk like how we think companies are supposed to talk to each other, I guess, not recognizing the fact that companies are just collections of people and you want to talk to humans the way humans talk. So I totally agree with that. And I thought the event personified that in a very authentic way. So again, well done. I'm glad I got to see you. I think I gave you a hug briefly and then you had to run off to the 19 other things you were doing, but we got to see each other briefly. And now, of course, we get to do one last Not Fintech Investment Advice for 2025. And Simon, before we hopped on, you were telling me that you did some real prep for this. So I'm gonna defer to your really well studied, prepared, thoughtful approach for this last podcast of the year. And I'm going to let you go first for our first fintech company.
I am honored, sir. My prep was quickly going back to an old brain food and looking at something I'd already written up, but I'll take it. So first company from me this week, Trudenty is a risk intelligence for first-party fraud. So what they do is they build a network of trust between card issuers, PSPs, and e-commerce platforms to identify first-party fraudsters. And as you well know, Alex, this could be better described as somebody chancing it, somebody saying that the goods were never received, but they really were, somebody issuing a chargeback even though the product works perfectly well. And what they've done is they use federated learning to be able to ensure that data never leaves its origin. So it never leaves the card issuer, it never leaves the PSP, it never leaves the merchant, but they can sort of correlate who are these bad actors that keep popping up in all of these different places. So federated learning's a really interesting idea for this type of problem space. And it means as an e-commerce merchant, if you're using Trudenty, you could choose to check that first to see, hey, have you seen this device or browser or something before? Then anywhere in the network, not just from my consortia or my fraud provider who might, Sardine has 5 billion devices, that's good, but somebody else might have something else, right? And so this is that federated learning model that I think is really cool. And they shared a wild stat. I saw them demo at the MasterCard Start Path in London. They said 80% of chargebacks are fraud. So this consumer protection button is actually a fraud button. Isn't that wild? 6 out of 10 BNPL customers use chargebacks.
That's crazy.
Isn't it? So this is fraud's largest problem, and it's the fastest growing. So these networks are much needed, but historically, these consortia were sort of closed conglomerate things. It's it was built around one vendor or early warning services. It's for the banks, just for the banks, and nobody else can have it. And now Plaid has Beacon and Sardine has Sonar. There are more egalitarian efforts out there to share data. But what I liked about Trudenty was this federated learning thing. They've really pulled that off. And I think that reputation network is an idea that could have legs. So what say you, Mr. Johnson?
Well, I think it's fascinating. I mean, this is obviously always the problem that, people kind of struggle, I think, to solve because, as you said, I mean, 6 out of 10, that is surprising to me, but not surprising at the same time. Does that make sense? It's a shocking number, and yet it's sort of reflective, I think, of anecdotally, the reality we all experience. the first party abuse is kind of out of control. And I think that this idea that you can have kind of a balance between privacy preserving kind of technology but also like a network that like meaningfully cuts down on this type of activity makes a lot of sense to me. I guess the question I have for you, and maybe it's a function of like where you start with, right? With like PSPs and acquirers and merchants and kind of starting in payments maybe is a good place to start with this. But how do you sort of solve for the fact that there are a lot of other providers that also have tried to do this or are trying to do this, right? Like there's no shortage of people who are trying to sort of share intelligence like this in order to stop this behavior. So like from a go-to-market perspective and a signing people up to add people to the network, like how do you differentiate what you're doing here versus all of the other solutions that are out there? Because I would imagine, like, if you go to a merchant and say, hey, this is the pitch, they're going to be like, yeah, I've heard this pitch a few times before. Like, what do you say to like, well, this time is different. Here's why.
So they've bootstrapped it two ways. One, I think they're being really focused. They're selling just to the reputation network, nothing else. And two, they had Worldline, who were one of the big acquirers, merchant acquiring processors. They had JP Morgan Chase and MasterCard.
So that helps.
So that's a good start. And I think with just that, they're saying, look, we've got a lot. They'll try and obviously bring more people to it. But I would imagine between just those three, they've probably seen enough stuff to be valuable.
Totally.
And there will probably be other networks out there. But this federated learning of like, okay, now it's going to work with your data. Do you want to join this? So everybody that comes in, everybody they sell to, they can give you data right away. But also then it's federated learning. So why wouldn't you share this with everybody else, especially if you're going to get paid for it? So I think it's just the simplicity of like, that's all they do versus here's the 35 other products. Oh, and we have this trust network thing. This is, we're a trust network. That's what we do. That's all we sell. And sometimes focus is a useful thing.
Yeah. Well, it's funny you say that. I mean, I think to your point, there is like an element of, I think oftentimes overcomplicating things, right? Where it's like sometimes we just do too much and the actual answer is like do less or do it in a more sort of simple, straightforward way. So I actually, it's a simple answer, but I like it because I think it does speak to the over engineering that you see in this space a lot, which I think actually does create quite a bit of problems. I think the other thing that I'm curious about with these guys is, I'm trying to think of the right way to describe this. I mean, you obviously worked at Sardine. You're an advisor at Sardine. Like you've been living in this world. I'm fascinated by I'm trying to think of the right way to describe it. The trade-off between sort of quantitative versus qualitative data. And what I mean by that is there are some metrics or some risks that are relatively kind of quantifiable in nature, right? Like this piece of data information doesn't match this other one. Like there's a mismatch between these two. We can run it through a model. It's very quantifiable, and we can say like, there's a risk here. This is obviously something that doesn't match. The reason I think the qualitative side, though, is interesting is first-party fraud is tricky, right? Because first-party fraud is about intent. First-party fraud is not something where you're able to necessarily, in a quantitative fashion, say, oh, well, this risk signal doesn't match this risk signal, therefore it is a fraudster trying to do something bad. It's more a function of like, yeah, we're looking at this particular payment transaction and, even though this identity data matches and this person is who they say they are, we think they are going to be committing a fraudulent chargeback, right? And so like first-party fraud, much like credit risk, is in some senses more of a qualitative judgment. There's a little bit more of an art to it than a science. Yeah. It is, yeah. And the reason I think that's interesting is, obviously every individual participant in the value chain has their own opinions, right? So like a merchant is going to think about this differently than a payment processor is going to think about it, which is different than how like a MasterCard is going to think about it, which is different than how a bank is going to think about it. But when you start to share this data, right, when you start to create like a network, a trust network where these insights are kind of being shared, and maybe it's too early to say how this is going to work itself out with these guys, but like, how do you facilitate sharing of data without necessarily imposing one person's opinion on someone else? Does that make sense in the context of first party fraud?
Yeah. So most people in the fraud space follow a similar pattern, and it looks like from their website, Trudenty is the same. So you can buy the opinion. So the opinion of the vendor is this is a medium trust customer because they've missed some payments. They've, kind of like their identity is a bit sure. They've done a couple of chargebacks, but not too many. This is the top level, like high, medium, low. You tend to see that quite often. And then you decide whether you want to block the mediums or you want to step them up or not. Like that's your risk appetite to see. Below that, you could just return the signals themselves. Well, actually, this person's chargeback frequency is X. Their settlement failures is Y. Their declined, the returns and refund requests are Z. You can actually give the qualitative outputs. Or you could go a layer deeper than that, and you could go to the machine learned features, and there might be a whole bunch of things that turned into that signal from a bunch of other things. And you could look. So it's almost got like a pyramid of how far down do you as a payments team and a fraud team want to go in order to make your decision? Do you want just the opinion? Do you want the signals? Do you want the features? Do you want the actual raw metadata? You might not be able to get at that because it's federated learning in this case. So you're sort of working with it. So there's risk appetite on how do I want to make my decision? And then there's the risk appetite on what decision do I make given my objectives? And I think every payments team there would look at, well, I really hate first party fraud, but if I block it too hard at this threshold, then it hurts my sales. But I'm going to put it here, which is the sweet spot where I can bring my fraud rates down, but my sales are still, 99% of what they would have been, or even slightly better. It's in a good spot. So that's the balancing point, right? Because the perfect, you could have zero fraud if you have zero sales. It's very easy to totally do that. Again, a little bit like the lending. You can have zero risk if you just don't lend any money to anybody. So if I'm a merchant selling high-priced items or luxury goods, my risk threshold might be different to fast-moving fashion.
Totally.
And so what looks like fraud to those two different segments will look quite different. So there are good reasons for the risk appetites to be different. So you tend to value those signals in different ways depending on who you are and depending on what you're selling and depending on what loss rate you're willing to absorb. Because, my margin on one sale might be really high for the luxury goods, but my margin's a lot lower on, groceries.
Yeah, that makes sense. And I think, going back to your point about what levels of data you make available, right? I mean, that depends on the level of sophistication that the merchant payment team has in terms of how they want to look at it. And is it like the, red, yellow, green? Is it no, I want to actually see what some of the underlying data is? Do I want to get down to the features of the machine learning model? And I do think it's interesting because, one, to your point, with that federated learning model, not every little piece of data is necessarily going to be available, right? That's part of the cost, I suppose, of the privacy preserving sort of approach to this, and which brings more participation in, but it also limits the amount of granular data I would imagine you'd be able to see. So there's kind of a trade-off there. And then the other trade-off that is really interesting to me here is you also are going to run into regulatory issues depending on where in that kind of level you want to sort of settle out. And in the US, when you start sort of sharing red, yellow, green opinions, you start to get a little more into the FCRA, credit bureau type land from a regulatory perspective. And so how you choose as a network to sort of express your opinion and how you package that does have some really interesting kind of regulatory opinions. But I think overall, it's absolutely fascinating. And starting with the companies that are plugged in that you mentioned, like if you have Chase, you're well on your way to having a really strong network. The last thing I'll say about this one, Simon, is I am so excited for more of this type of stuff to exist so that a person who does not commit chargeback fraud, can have like a VIP lane of like great experiences working with merchants and card issuers where they never hassle me at all because they know that I'm incredibly low risk. I really get tired of getting lumped in with the lowest common denominator when merchants do a bad job of managing chargeback risk, because then it's like everything becomes adversarial, and it's like, guys, no, look at my history. Like I never commit first party fraud. I never commit chargeback fraud. When I bring something to you, I want you to take that seriously. And like that level of differentiation and discernment is only possible when you have this type of network behind the scenes.
It is as well. I'm a big user of guest checkout because I don't want to sign up for your spam. Like merchant, I love you. I know you can reactivate me if I give you my email, but no, you're not having it. But also because I'm using guest checkout doesn't make me a first party fraudster. But hey,
how do they
look,
know?
in Europe, pretty much every transaction we do has step up authentication on it anyway, because we have strong customer authentication. So I'm just used to, I'm trying to make a payment. Oh, yeah, got to authenticate. It's just normal. But it's become
so much safety. Yeah,
it's become so normal now that like because the point of sale generally is a bit higher performance in Europe. Like you don't have this like how many buttons do I have to push and how many charities do I have to donate to and then how much am I going to tip and all of this crap. You just have like I've paid and it's done and the tax is dealt with. So you hit the pay button and then you might have thumbprint done. So actually that's quite slick and it's quite secure. But that's a tangent. But this is actually quite popular. Trudenty is doing well in Europe. So interesting that the home of GDPR is doing a lot of data sharing.
I love it. I mean, it gets me into sort of a depressed state a little bit when I think about how other countries are moving past the US on data sharing, but that's also a different podcast, so we won't even go there, Simon. All right, can I give you my first company?
Please do. I am excited to hear it, sir.
All right. So mine is a company called Tidalwave, and they are doing agentic AI for mortgage point of sale. And so the basic idea here is that the process of getting a mortgage has evolved over the last, 20, 30 years from being on the sort of borrower-facing side a paper-based process where you had to go to a loan officer at a branch or a non-bank mortgage lender somewhere, fill out a bunch of paperwork and walk through everything and bring in a bunch of documentation, to us having digitized that process. And this is companies like a Blend or an Encino or even some of the more legacy providers like ICE do this now pretty well. But still, we've digitized a really burdensome process. And sure, we found a couple of little shortcuts to take, little places to find additional efficiency. It's definitely faster than it used to be. This is why, by the way, like Rocket Mortgage became the largest mortgage originator in the US, is because they simply just digitized a really, really painful front end process. To say nothing of all the improvements they made on the back end. This is taking that whole evolution one step further, which is to say, what if we unleashed a set of AI agents on all the steps in that process? So not only have we digitized it, but we are going to have kind of in some ways the best of both worlds between a digital process and human loan officers, where the process is digital. You plug in all of your data, you fill out the application, you do all the things that you normally do, but at any step along the way, when something goes wrong, when we need to connect to another data source via an API in order to go grab some piece of data that we didn't know that we needed initially, or we need to go back to the customer and ask them a question, or the customer submits a piece of documentation, but turns out the picture they took was slightly off center and we didn't get all the data that we needed. Now we have this swarm of AI agents that can just immediately, persistently, and politely get involved and help orchestrate that process and just smooth out any of the bumps. And so, you and I have talked many times on this podcast about where agentic AI adds value. One of the best places is whenever there's sort of this friction between rule-driven processes and the humans touching those rule-driven processes, because humans are messy and the answers they give are messy and they get confused and the data they supply is sometimes unstructured or isn't right. This is basically Tidalwave applying agentic AI to kind of smooth out all those rough spots, mostly on the front end of the mortgage servicing, or I should say mortgage originating process, but with also some ties back to the back end to help the loan officer who's going to be picking up this product and helping to actually do the back end origination. So raised a Series A recently, seems to be gaining some initial traction. I love the concept, but I also think mortgage is one of the hardest areas to just be a startup in from a go-to-market perspective. And there's a lot of very established companies in this space, a bunch of whom I've already mentioned. So what say you, Simon? What do you think about this use case?
It's funny. I saw a bunch of chat-based mortgage origination companies in the UK in like 2018-19. And they got to like Series B, Series C, because it turns out like text is actually quite a good way to answer some of the mortgage questions, because they're really annoying. Like, how long have you lived at your house? And, what's your income? Actually, that as a conversation is a lot better than like filling in a form somehow.
Totally. Well, because they'll ask like weird follow-up questions, right? It's with mortgage, it's never simple. It's never like question answer. It's question answer, 4 pain in the ass follow-up questions based on your answer. So it is a conversation.
Yeah, it's hard to build the UI for that. And it's hard to do that that's multilingual and patient and available 24/7. So there are so many edge cases where you can fall out of the UI process that actually having an agent to catch that just makes a lot of sense. And generally, I like agents that are really well trained on like a specific workflow, because the more you RL them into a workflow, the more consistent the performance starts to get and the better the results get, and training them on your best people. I think that sort of like interesting question of, can somebody get this to be hallucination free? I'm seeing this on their homepage. Is sort of it's funny how that's like faded into the background as like the thing everybody worried about with AI. But they have a patent pending mortgage contextualizer that ensures that their Tidalwave AI is hallucination free. Patent pending. It always sounds like snake oil to me. Like, it's just like,
well, like if they had actually built a thing that could completely eliminate hallucinations, wouldn't they be raising $1 trillion? Like, I mean, not to be like glib about it, but like, yeah, I'm with you. Like, patent pending, we solve the biggest problem in the most important technology that's ever come across. Like, it strikes me as maybe a little bit of an overstatement, perhaps.
But probabilistically, if you RL some agents on a specific workflow enough, you can get the error rate well below where a human would ever be. Like, unbelievably good.
Totally. Well, and I think the other thing about that is this is the front end, right? This isn't like the risk decisioning part where like you're going to, it's like, this is, can it outperform a entry level loan officer who gets frustrated and doesn't speak other languages and needs to sleep at night? Like, can it outperform that person? Yes, right? For sure.
And I think that performance and ROI is what people are starting to understand. Is the obvious one, yes, multilingual, yes, 24/7, but also converts more sales and makes less errors. And when you look at the higher conversion and the less errors, you start to think, well, why wouldn't everybody do this? Like, the numbers do speak for themselves with some of these things. And it's interesting that the team is like the ex-CTO of Better. And, like, there's a lot of better.com alumni in here, but there's also, like ex-Google and
ex-Encino.
Yeah. So there's this real like super team of people that have done this before, and they're just applying AI to it. So team looks good. Product makes sense. Who are the customers, Alex? Do you know? Have you seen any use cases here of like who's out there?
This is a great question. Yes. So just to give you a little bit of background on that, they are projecting that they will be able to get to about 200,000 loans annually. So they do have some existing customers deployments with lenders like First Colony Mortgage and Mortgage Solutions. And then I think the one that jumped out to me the most was in the Series A, they raised $22 million. D.R. Hutton, which is the largest U.S. home builder, was one of the sort of investors in this round. And I think that's really interesting because, the like, I always refer back to Built as the classic example of this, where it's like anyone who you need to sort of be a participant in your solution in order for it to be successful. The new strategy, and Built is the best at this, is get them to invest in your company, because then they will be having skin in the game. They will feel motivated to partner with you. They will be the first customer or the first partner or the first distribution channel. And so that one stuck out to me, as these guys didn't just raise $22 million. They don't just have a team of people, like you said, who have a lot of experience in this space, but they raised money from the largest U.S. home builder, which speaks to kind of the natural sort of stickiness and integrations that they're probably already starting with. So going back to the question I asked earlier about how do you grow in mortgage? How do you go to market in mortgage? How do you displace all these incredibly powerful incumbents in mortgage? That's how you do it, right? Is you start with some of these kind of large partners or customers and getting them to have skin in the game very early in your journey. So I guess TBD in terms of exactly what that investment is going to manifest in terms of like partnerships or distribution advantages, but that seems like a good early sign.
Strategic investment gets a dirty name sometimes. People don't like to see enterprises in the cap table until you're very late in your journey, historically, with startups. Sure. But actually, for this segment, I think it makes complete sense. And if you look at some of the fintech funds like Commerce and Nika and those sorts of guys, go look at their LPs. It's often the case that the fintech funds that have done well are the ones that are backed by potential customers of the companies they invest in. And so why wouldn't that track for mortgages just as well? Is there any regulatory sort of like challenge that they're going to face into here? And do you think they're sort of like, it doesn't hallucinate messaging is like trying to deal with some of the worries there?
I'm sure it is. I mean, mortgage in the U.S. is like outrageously, I would actually almost argue overregulated. And it has to do with the fact that government guarantees in mortgage are so extensive that the consequence of that is there's a lot of process and a lot of regulation wrapped around it. So I do think that will be a challenge. I imagine that their really strong messaging on this doesn't hallucinate is very much aimed at making regulators comfortable and making like mortgage lenders who are used to dealing with intense regulators sort of feel comfortable enough to sign up for this. But again, I also go back to the fact that like in mortgage, there's the LOS and there's the POS. And this, like all things agentic AI make way more sense to me in mortgage on the POS side and not on the LOS side. The LOS side, like there's actually a lot of low-hanging fruit for agentic AI on the LOS side, just the same way that there is on the POS side. But I think if you go that direction first, you open up a much bigger can of worms with regulators. Whereas if you stick more to the POS side, I think you have a less of a challenge, not zero, but I think less. And I think regulators are probably a little more open to, oh yeah, I could see how this would have value. And this ultimately, none of this really affects like the decision that's being made on does someone get a mortgage or not. It's more, in some ways, I think it's more about sort of filling the cracks at the top of your funnel, if that makes sense. Like if we think about mortgage lending as this big, gigantic funnel, POS is like the top of that funnel, and there's all kinds of leaks and problems at the top of the funnel. This is kind of spackling the top of the funnel and sort of solidifying it it doesn't really speak to what happens after the mortgage lender has all the information. And, I think there's even steps like in the US, one of the really sticky wickets that happens kind of later in the process that can derail the whole thing is the appraisal process. And I think like agentic AI applied to the appraisal process would be fascinating and potentially very, very valuable. But that's also, again, where you're like courting a whole bunch of like regulatory uncertainty that I don't know that mortgage lenders are quite ready to dive into. So it makes sense to start here. When it comes to your payments provider, you can't afford to compromise. Marqeta's modern payment solutions flex with your business without the trade-offs. Stable and agile, secure and innovative, scalable and configurable. If they say you can't have it all, don't believe them. Your business demands more. Choose a payments provider that delivers more. Choose Marqeta. Visit marqeta.com/FTT to learn more.
Great place to start. Well, I wish them well. I hope they can succeed. Because I'm sure you've been through a mortgage process or two, and I think everybody's wanted to reinvent that thing as soon as they go through it. It's uniquely painful.
It's horrible. As
you were talking like on the POS side, you think about Rocket Mortgage and Better and a lot of these guys. If you think about where their innovation was, to your point that you made at the very outset, the successes in this category have started there. And so starting that, and this is AI. If AI is the new platform, if it's the new UI, then surely this would be where it goes. Great team. Seems like they've got it all. I just don't know about that zero hallucination promise. I want to see this patent pending. I'm not going to let that go.
No, you shouldn't. I mean, I think it's funny, but like, and you and I talk about this a lot on the show. You have to be really careful and precise with how you talk about these things, particularly when you're talking about a technology that's so hyped/overhyped, right? We talk about this with stablecoins. We talk about this with agentic AI. Like the hotter the technology, the more you need to be just incredibly precise and careful with how you're saying things and making sure that you're not
slightly under-promising.
Totally. That creates more credibility when you under-promise.
Yeah,
and you acknowledge the flaws.
Better than human level error rates, or we're wildly focused on error rates, or all-time low error rates, or come see how we've reduced errors.
Here's how here's where we put the human in the loop to make sure. Like it's just sort of acknowledging the reality that like these things probably will still hallucinate a little bit. We can't get it down to zero, but again,
which I'm sure happens in the sales pitch. I'm sure that happens in person. I all credit to this team.
We're just looking at the website.
Yeah,
that's right.
Yes.
Yeah, no, you're absolutely right. All right, Simon, give me your second company, sir.
So this is Kaaj, agentic AI for loan origination. Funny that.
Hey, now, yeah.
So they're using agentic AI to read bank statements, paper documents, identity forms, and financial statements to create an automated credit memo. So that's what you were just sort of talking about. They overlay this with a workflow solution for customers who are onboarding in SBA lending or equipment finance.
Ah, yes.
Ooh, so this is like a sweet spot of lending, isn't it? This is heartland stuff. And they say they've helped lenders originate $5 billion to date. And what I sort of see in this is like every generation has its new lending origination platform, but I always wonder about how big these companies can kind of get because of who the customer is and who they're selling to. It's obvious to me that agentic AI performs meaningfully better at reading paper documents and statements, and it can just deal with the messy fact that no two statements look the same. And no two financial documents records look the same, and it can sort of make sense of them. So I can see how they've got a bit of a competitive edge, but there are 20 companies that look a bit like this, and it's kind of hard to sell to the big banks. So you got to sell to the mid-size, maybe the non-bank lenders. But how many of those are there that haven't built them themselves if they're a fintech company? So. Like this needs to exist for the smaller non-bank lenders and the smaller banks, but does this scale? And what do you think of the sort of SBA and equipment financing lane for somebody to be in for from a lending standpoint? Have you seen anything go there?
Yeah, I mean, you're right. This is a very popular idea, and it's popular because it makes sense, right? Like, I feel like sometimes you and I talk about companies where we focus more on like, does the idea make sense? Is this the right thing to build? And then sometimes we talk more about this is obviously the right thing to build. Who gets to win here? And I think this is more the second one, in the sense that I know of, yeah, probably a couple of dozen companies that are aimed at a similar version of this problem, which is essentially the ideas you outlined, which is small business lending is weird enough and bespoke enough and different on a business by business and vertical by vertical basis that it sort of defies easy automation. And yet, it's not nearly profitable enough on an individual loan basis to justify having human beings touch it at all, right? And so, to your point about different size lenders, big banks just don't do this kind of work, right? They don't do SBA lending, they don't do small business lending, they don't do equipment finance, they don't do any of this stuff because they're busy doing like big ass commercial loans that are bespoke and super profitable, and they just throw humans at it. Um, this is the realm of smaller lenders, right? Community banks, credit unions, MDFIs. Like this is the world that all of those institutions live in, and they need help, right? Because they want to serve small businesses. We obviously know that there's a huge credit gap for small businesses in getting financing. Speaking of the SBA process is designed to mitigate the risks that lenders take by providing a bit of a government guarantee. But to get that government guarantee, you have to go through just a horrific amount of paperwork and process to get approved for an SBA loan, to get an SBA loan through. And so, like, can we throw AI at that? I think it makes all the sense in the world. To your point, I think the question is, like, for these guys, how do you go to market? How do you differentiate what you do in this space? And it's interesting looking at this, looking at their website, and again, we're just kind of evaluating them from the outside. It seems as though they are maybe a touch more focused than other ones I've seen on, more like kind of loans made by credit teams. I'm seeing sort of discussed on their website.
Yeah, because it's getting to the credit memo, right? Like it's a credit team that's got to a credit memo. So they're trying to go from like business verification to cash flow analysis to asset valuation to financial analysis to risk assessment, right? So it's all the way across from I've never seen this customer before to credit memo, and we're ready to hit send, which is quite nice. Like if you think about the amount of companies that you would have sort of put together, you maybe have a mid desk and then LOS and then customer service bot and all that sort of stuff. And the founders, so the CEO was at Uber and Cruise. The co-founder was at American Express, Uber, and Varo Bank, interestingly.
Interesting.
So, some DNA in tech, some DNA in lending. Maybe.
Yeah.
Maybe.
No, absolutely. I mean, well, it's interesting because the point you made about it doing all the different steps one at a time, boom, 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 boom. To me, that is interesting because I do think that, like, trying to think of the right way to describe this, the more complex the small business loan product, the more this type of thing has value, right? And so, like, if you think about small business lending as sitting on a continuum, you're making a loan to a small business. It's not a big, large enterprise commercial one that a big bank is going to want to compete with you on. It's a small business. But how complex is the loan that small business needs? On one end of the continuum is like Square Capital, right? Where it's like, hey, we're going to look at your incoming invoices and kind of payment stream coming in. We're going to underwrite a future portion of that, and then we're going to take money directly out of your payments that you're processing until you pay us back. That's like very simple, very straightforward. Doesn't involve evaluating any assets. They already have like the small businesses sort of identified from a KYB perspective. Like it's all just very straightforward. On the other end of the spectrum, it might be something like equipment finance, right? Where it's like large amount of money. Oftentimes equipment-based loans are based on like a plan that the small business has to expand and to do something beyond what its current financials would suggest it's capable of. So it's kind of a bet on the future a little bit. It requires you to evaluate the collateral of the thing that they're buying with the equipment loan. Like, it's just very complex on like 9 different levels, and oftentimes does require like a credit committee to look at it from all of those different angles. So I wonder if one way to think about agentic AI applied to small business lending is the more sort of thorny and knotty the credit product is for the small business, the more value it has, versus like if you can sort of strip the small business lending product down to be simpler, then you have something that's more easily automated, which is kind of what Square does. So like on that continuum, lean towards complex, lean towards thorny, lean towards the type of things that, you know, a bank might try getting into that business for 2 years and then just go, you know what, the hell with it. We can't do this. It's not worth it. Like, that's where you want to focus.
And the effort it takes to underwrite $100,000 is the same as $5 million for some small businesses for certain loans. So this creates this gap at the bottom end of the market for small businesses. So it seems like the Kaaj guys on their website are saying that's what they want to go after. I love that motivation. Please do it, guys. Please succeed.
I totally agree. And actually, that is a perfect lead-in, Simon, to my last company. Can I pitch them to you real fast?
Yeah, go ahead.
All right. So this is a company called FinReach Solutions, and they are actually based in India. So I'm going a little outside my comfort zone here, but they work with small businesses. So they essentially exist as a platform that sits in between lenders, so banks, non-banks, that type of stuff, on the one side, and then guarantors, so development finance institutions, impact funds, any organizations that basically exist to funnel capital to support micro and small businesses. And they basically design and run sort of automated credit guarantee programs so that lenders can extend collateral-free or lower collateral loans to small businesses or micro businesses that they otherwise wouldn't be able to approve. So obviously in India, like, all of these problems are just bigger than they are in the US, because India just is a bigger market in that way. More people, more small businesses, more like just activity. So, you know, from the research I did, it seems as though like this credit gap that we've been talking about for small businesses, it's about $300 billion in India in terms of like unmet credit needs. And if you look at like credit penetration for these micro and small businesses in the US, like, there's still a big gap. It's at maybe like 50% penetration. In India, it's like 14-15%, right? So like the level of like penetration of getting down to these micro small businesses is really, really challenging. And so, you know, India has a bunch of different ways they solve this. They have their own sort of government guarantee programs, kind of similar to, you know, an SBA type program. But they also have lots of these kind of more private market sort of guarantees. But the problem is those are all bespoke, right? And the guarantors have a really hard time working with lenders and doing it in a programmatic way. And so this is essentially infrastructure that sits in between the guarantors and the lenders to just sort of automate and structure and kind of productify that to make it easier and more efficient. And I guess the two things about this that were interesting to me, building on our last company that we were talking about, is one, I do think in the US, we could stand to have more of this type of infrastructure, because as we were just talking about, like, we have SBA, that's great, but we don't have any infrastructure that sits between the government and all of these lenders. We force lenders to work directly with the Small Business Administration, and it doesn't work well, which is why there's actually not that many Small Business Administration kind of qualified lenders in the US. It's really hard to build that level of expertise. So I like the idea of building more.
It's like a plaid for the SBA. Like,
it really is. That's exactly what it is. Yeah. Or another analogy might be like Stripe Atlas for SBA, right? Like, it's that thing that takes all the things,
just guides you through the workflow. It hides all of that gnarly government stuff and pushes a load of buttons for you, fills in a load of forms for you with a clean UI, and it's really productized and it's optimized to succeed and convert. Wow, this is almost like partially manifesting a thing, isn't it? Like, you're trying to bring this to the US. You know, like,
I want to bring it to the US. That's exactly right.
what are all of those gnarly bits of government that have programs that extend lending or guarantee some form of lending? We've seen a little bit of this, like people trying to go into the Fannie and Freddie data sets and trying to make all of that data collection. That's now become more of a thing. Maybe SBA is the next big one.
Yeah, I mean, and I know that there are lots of, it's interesting because it's like, I know there are, going back to our previous conversation, I know there are lots of companies working to make banks more efficient in dealing with SBA, but it's like they kind of go to the bank first. They don't try to build more of like a single platform that kind of sits in between both sides. And I'll say the other thing that's interesting about it is there are lots of other sources of capital out there besides the government guarantees, right? And so I think this same infrastructure doesn't just have to be built to sit between the government and lenders. It can also sit between impact funds. You know, like we have minority deposit financial institutions in the US that exist to serve sort of underserved communities. And they actually get a lot of support from like institutional capital from various sources. But again, like oftentimes they don't have the best technology to sort of interface with those sources of capital. I even think this type of infrastructure could sit between lenders and private credit funds, right? So like there's just, to me, like we have lots of capital and people who are looking to put money to work in various purposes. And we have lots of lenders who can deploy that capital. What we lack is the infrastructure that sits in between. So I found them fascinating.
Yeah, I want to see this exist. Like it's kind of interesting how often or how rarely we are inspired by what we see in the developing economies. And India is such a dynamic market. But what you've done there is really interesting is you've changed the context because what works in India doesn't work in the US and vice versa.
Right.
But if you take the sort of the core first principle idea and go, well, what they've done is they've made this messy many-to-many process streamlined. Where can we apply that same idea in our home market? I noticed the Midjan network invested. Good friends of mine, Nick over at Ribbit, we were talking at FinTech NerdCon, and he said, some of their best growth companies are just companies outside the US that nobody's heard of that are doing extremely well, solving problems for their market in idiosyncratic way. But what happens then is, as an investor, is you sort of spot the pattern. And then you can bring that to the company you're on the board of in the West and go like, hey, like, what if you tried this? And that pattern matching is something we need to do a lot more of. It's something, in FinTech Brain Food, I speak a lot to the US audience, frankly, because it's where the numbers are. But I need to do more global stuff because I find it expands minds in really good ways. So thank you for bringing this, Alex.
Oh, you're welcome. What you just described is a resolution I have for 2026 to do that more because I feel the same way. And I think there's a lot that we can learn from these examples in other markets. And so I'll try to do more of this in the future. Simon, I'll count that as my manifesting an idea, but I know you have one you want to manifest as well. So I'll let you close out the pod. What do you want to manifest in FinTech?
Well, I'll get to that in a second. I just want to mention to you that I'm going to be at Abu Dhabi FinTech Week next week. And speaking of like entrepreneurial excitement, like that great place to be. So try travel more. Reach into that work week budget and get yourself out to these things. That's what you got to do, my friend.
Patience of my wife is, I think, the more limiting constraint. But as the kids get older, I think that might loosen up a little bit. So I will definitely keep that in mind. Be fun to bump into you at a conference not in Las Vegas, to be totally honest with you.
Well, and not in Miami. So you got it, sir. I want to manifest a cure to financial nihilism. So we know about Frank Rotman's financial nihilism. It's now making Main Street press. Student loans are on average $40,000 up to $100,000. We turned home buying into a retirement activity. The average home buyer is 60. The average first-time home buyer is 40. And yet these stats keep coming. And what I see in all of that is a lack of solutions. A lack of people doing things. And any solutions we do have seems to be get people into more debt. And I'm like, what if there were genuine alternatives to the incentive mechanisms that student lenders have? Like, what if you had to lend based on the employability of that college degree? What if you had to lend on a mortgage? What if, as a mortgage, you viewed a college degree as an asset, not a liability for that borrower because they were likely to earn more? Or what if we just like didn't account for that in the affordability standpoint, or like some offsetting thing? There's probably so much we could do to help with just financial products, because I don't think the answer is a government bailout for this issue. We need to structurally. And what about if we had a bond for investing in home building? Like, what if we could turn the fact that consumers have no savings into an opportunity for them to invest in the future of the country they live in? So I get really passionate about that. You know me, Alex, I'm an optimist. I'm still of the belief that crypto will come good, that prediction markets will one day be useful, as horrible as both of them can be at times. I am an optimist, but sometimes that just makes me manifest and want the change so bad.
No, I love it. And I will just say quickly that Frank gave this pitch at my FinTech Takes Builders Summit in Montana last month. And it was incredibly compelling as a problem statement. And I completely agree that it is the problem that will define the back half of the 2020s in financial services, in my opinion. So let's manifest a whole bunch of solutions to it. I love it. And Simon, this is the last episode of 2025. Thank you so much for doing this all year with me. I'm so glad that FinTech NerdCon was a success, and I look forward to doing this and many more things with you in 2026.
Likewise, thank you as always for having me. Listeners, you can catch me at fintechbrainfood.com if you want to reach out. It's Simon at fintechbrainfood.com, and right. I'm happy to respond. Take care, guys.
Yeah. Thank you.
Bye for now.
Thank you for listening to this episode of FinTech Takes. Stay up to date with emerging companies and the latest FinTech trends by subscribing wherever you get your podcasts. And if you love FinTech Takes, please tell a friend.